Why so many people seem to lose money in the stock market? It's a question a lot of us have asked. But what if the reason is, well, what if they're just on the wrong side of the trade? Today, we're going to flip the script and look at that other side, the world of options selling.
I mean, just look at this number. The statistics are pretty brutal. Studies show that up to 90% of active traders end up losing money. That's a crazy high number, right? It really makes you stop and think, if almost everyone is losing, who's winning?
Well, it turns out that while most of us are caught up in the excitement of buying options, the real game, the one with better odds, is often being played by the sellers. They're playing a completely different sport with a totally different rulebook.
So to really get this, we've got to break down the core difference between an option buyer and an option seller. It's not just a different strategy, it's a whole different way of thinking about the market.
Here's the best way to think about it. The option buyer, they're basically buying a lottery ticket. They're hoping for a massive payout from some big, dramatic move in the market. But the option seller? The seller is the one running the lottery. They're like an insurance company. They collect a small, steady payment, a premium, by betting that a catastrophe, a huge market swing, won't happen. They make money from things staying relatively normal. And that premium the seller collects, it's all thanks to this incredibly powerful, invisible force called time decay. You'll also hear it called theta. See, every single day that ticks by, an option contract loses a little bit of its value. For a buyer, that's a nightmare. But for a seller, that decay is their income. For them, time is literally money.
Okay, so why on earth would anyone choose to be on the selling side? It sounds kind of boring compared to buying, right? Well, it all comes down to three really powerful advantages.
Advantage number one, and this is the big one, is the probability of winning. It's just way higher. Unlike a buyer who needs a big move in their direction, a seller can make money three different ways. They win if the market moves in their favor, they win if it stays totally flat, and they can even win if it moves a little bit against them. This gives them a massive statistical edge, usually around a 66% chance of the trade being profitable.
Advantage number two is that best friend we just talked about, time. Every day that passes, that time decay we mentioned is working for the seller, chipping away at the value of the option they sold. This means their position actually becomes more profitable just with the passage of time, even if the stock price doesn't budge at all.
And number three, honestly, it's just a less stressful way to trade. Option buyers are often glued to their screens, just hoping and praying for a big move. A seller, on the other hand, just defines a safe zone for the stock. As long as the price stays inside that range, they're good to go.
Now this all sounds pretty fantastic so far, doesn't it? High probability of winning, time is on your side, less stress. But, and this is a huge but, this is where the story takes a very sharp and very dangerous turn. Because with all these advantages comes one massive, scary risk.
Which leads us to the most important question you have to ask before even thinking about the strategy. What's the catch? What is the hidden danger here that can turn this high-probability trade into a complete and total catastrophe?
And here it is. This is the big, scary paradox. A seller's profit is always limited. The most you can ever make is the premium you collected when you opened the trade. That's it. But your risk, your potential loss is, in theory, unlimited. A sudden violent market move against you can wipe out your account and then some. Let's talk about what it costs to even get in the game. To buy one option contract, you might only need about $50. It's really accessible, which is a big reason why it's so popular. But to sell that very same contract, you might need to put up something called margin of around $1,500. That's 30 times more capital. The margin is basically a security deposit your broker holds just in case things go wrong. That huge difference in capital should tell you everything you need to know. This is a game with much, much higher stakes. And this really drives home just how severe that risk is. Because the potential for loss is so massive, selling options without a strict stop loss, an automatic order to get you out if the trade goes bad, is often called financial suicide. And that's not an exaggeration. One single trade that gets out of control can be absolutely devastating.
So we've seen both sides of the coin now, the really appealing advantages and the absolutely terrifying risks. So is option selling the right strategy for you? Well, that answer, of course, depends entirely on who you are as a trader and what you can handle.
So here's the final breakdown. On one side of the coin, you have a high probability of success, the powerful benefit of time working for you, and a less stressful trading day. But on the other side, you're staring down that unlimited risk, you need a lot of capital just to get started, and your potential profit is always capped.
And that is the fundamental trade-off, right there. It's the deal at the very heart of option selling. You are accepting unlimited risk in exchange for a limited, high-probability profit. And so the final question is really for you to answer. Based on your own goals and your own tolerance for risk, is that a deal you're willing to make?